Right now, somewhere in the financial district of Shanghai, a shift is happening that will likely rewrite the history books for precious metals. If you are watching the ticker tape, you see silver trading at $58 an ounce. You see a new all-time high. You might think you are looking at a bubble or peak or a moment to sell. But if you think that, you are missing the invisible crisis that is unfolding beneath the surface of the global economy. The price is just the smoke. The fire is in the vaults. According to the latest data released from the Shanghai Futures Exchange and the Shanghai Gold Exchange, Chinese silver stockpiles have not just declined, they have effectively collapsed. We are looking at a verifiable 86% drop from the pandemic peaks. In a matter of months, thousands of tons of strategic metal have vanished from the public ledger. And here is the statistic that should keep every investor awake at night. In October alone, China exported a record-breaking 660 tons of silver. They didn't put it on a slow boat to save money. Reports indicate a massive surge in air freight bookings for precious metals. They flew heavy bars of silver across the world to London. Why? Why would China, the world's manufacturing superpower, the country that produces 80% of the world's solar panels, empty its own cupboards during a historic bull market? The answer is simple but terrifying. The Western banking system is running on fumes, the London vaults are dry, the lease rates are exploding, and the paper-silver game that has suppressed prices for 40 years is finally colliding with the brick wall of physical reality. Today, we're going completely off script. We're going to ignore the mainstream financial news that tells you this is just normal volatility. We are going to conduct a forensic investigation into the Shanghai Signal. We will break down the exact mechanics of the COMEX failure, the industrial vacuum that is sucking up every available ounce, and the historical patterns from 1980 and 2011 that prove, mathematically, why $100 is not a fantasy. It might actually be a conservative estimate. This is the most important video I have ever made on silver. Sit down, turn off your notifications, and pay attention. The next 20 minutes could define your financial future for the next decade. Let's begin with the Shanghai Signal. To understand the magnitude of what is happening, you have to understand how the silver market usually works. For decades, silver has flowed into China. They are a net importer. They need the metal for their electronics, their infrastructure, and their massive solar energy projects. For China to suddenly flip and become a massive exporter of silver is like Saudi Arabia suddenly importing oil. It is a complete reversal of the economic order. The Shanghai Futures Exchange, or SHFE, tracks the inventory of silver held in registered warehouses. In 2020 and 2021, these warehouses were bursting at the seams with over 5,000 tons of silver. It was a strategic stockpile. But starting in late 2024, that number began to bleed out. First, it was a slow drip. Then, it became a torrent. Today, the data shows roughly 715 tons remaining. That is an 86% reduction. But the story gets darker when you look at why it is leaving. It is leaving because of a phenomenon called arbitrage. For most of this year, the price of silver in Shanghai has been trading significantly higher than the price of silver in New York or London. We call this the Shanghai premium. At one point, silver was trading for nearly 10% more in China than it was in the US. In a normal market, traders would buy cheap silver in New York, ship it to China, and sell it for a profit. That would close the gap. But that didn't happen. Instead, silver left China to go to London. This defies the laws of economics. You do not sell an asset in a cheap market when you can sell it in an expensive one, unless you have no choice. This suggests that the bullion banks in London, the entities responsible for maintaining the global price of silver, were facing a catastrophic failure to deliver. They likely tapped into Chinese reserves as a lender of last resort. They needed physical metal immediately to prevent a default on the London Bullion Market Association exchange. That 660 tons wasn't a sale, it was a bailout. And this brings us to the concept of lease rates. This is a technical term, but you need to understand it because it is the flashing red light on the dashboard. When a bank or a massive industrial user needs silver but doesn't want to buy it outright, they lease it. They pay a fee to borrow the metal. Historically, because silver is abundant and sits in vaults doing nothing, lease rates are incredibly low, usually under 1%. Sometimes they are even negative. However, in the last few weeks, the annualized lease rate for silver in London spiked to 39%. Let me put that in perspective. If you went to a car rental agency and they told you that renting a Toyota Camry for a week would cost you half the price of the car, you would assume two things. One, they are crazy. Or two, there are no cars left, and that one Camry is the most valuable thing on the lot. A 39% lease rate means the market is broken. It means that the owners of physical silver are terrified to let it out of their sight. They are demanding a massive premium because they are genuinely afraid that if they lend the metal out, they will never get it back. This is what we call backwardation in its most extreme form. It is the death knell of a paper manipulation scheme. Now, let's pivot to the demand side of the equation. Because even if the financial shenanigans weren't happening, the industrial fundamentals of silver guarantee a supply squeeze. We have all heard about the green energy transition. It's been a talking point for 5 years. But in 2025, the technology shifted in a way that most analysts missed. The solar industry didn't just grow, it evolved. For years, the standard solar panel used something called PERC technology. It was efficient and used a moderate amount of silver paste. But the industry has now aggressively shifted to a new technology called TOPCon and HJT cells. I won't bore you with the engineering, but here is what matters. These new cells are more efficient, but they require between 30 to 50% more silver per panel. At the same time, China installed over 250 gigawatts of solar capacity this year. To put that number in context, that is more solar power than the entire United States installed in its history, built in a single year. That single sector, Chinese solar manufacturing, consumed approximately 250 million ounces of silver. That is nearly 30% of the entire global mining supply. And that is just one country and one industry. We haven't even talked about AI. The massive data centers being built by Microsoft, Google, and Amazon run on high-performance chips and connectors. Silver is the most conductive metal on Earth. You cannot replace it. Copper is too slow. Gold is too expensive. If you want high-speed, low-latency AI computing, you need silver. Then there are electric vehicles. The average internal combustion engine car uses about 15 to 20 grams of silver. An EV uses up to 50 or 60 grams. As the world pushes for EV adoption, we are mathematically locking in a structural deficit. This brings us to the concept of inelastic demand. This is the economic force that will drive silver to $100 and beyond. Imagine you are Apple. You need silver to make iPhones. The silver in an iPhone costs maybe 20 cents. If the price of silver triples to $150 an ounce, the cost of silver in that iPhone goes up to 60 cents. Does Apple care? No, they will pay it. They will pay anything because without that tiny bit of silver, they cannot sell a $1,000 phone. The same applies to a missile guidance system for Raytheon or a solar panel for Jinko Solar. The industrial users are not price sensitive. They are supply sensitive. They need the metal to keep their factories open. When the shortage hits, they will not stop buying. They will panic buy. They will outbid the investors. They will outbid the bullion banks. They will strip the market bare because their business survival depends on it. This is exactly what happened to palladium in roughly 2019. The auto industry needed it for catalytic converters. A shortage hit. The price went from $500 to nearly $3,000. Silver is setting up for the exact same move, but on a much larger global scale. Now, I want to take a step back and look at history, because while technology changes, human psychology and market cycles do not. We have seen this movie before. Let's go back to 1980, the Hunt brothers. Everyone knows the story of how they tried to corner the market. Silver hit $50 an ounce, but people forget the context. In 1980, interest rates were nearly 20%. The dollar was strong, the US debt was manageable. Today, silver is at $58. We have barely passed the 1980 nominal high. But if you adjust that 1980 peak for inflation, using the government's own watered-down CPI numbers, $50 in 1980 is equivalent to roughly $178 in purchasing power today. This means that at $58, silver is not expensive. It is historically cheap. We are trading at a 66% discount to the 1980 highs in real terms. Let's look at 2011. The financial crisis of 2008 led to massive money printing. 3 years later, silver ran from $9 to $49. That was a 5x move. Now look at today. In 2020, we had the COVID crash. Governments printed trillions, far more than in 2008. We are now 5 years into that cycle. The timeline matches perfectly. The liquidity injection takes time to rot the currency, and then the commodities explode. We are in the explosion phase right now. But this time, the setup is different in one crucial way. The geopolitical chessboard has flipped. In 1980 and 2011, the West controlled the gold and silver pricing mechanism. Today, the BRICS nations, Brazil, Russia, India, China, South Africa, and the new members are actively working to de-dollarize their trade. They are hoarding real assets. China's central bank has been buying gold for 18 consecutive months. But the silver purchases are often hidden through state-owned enterprises. The drain of the Shanghai vaults might not be silver leaving China permanently. It might be silver moving from public exchanges, where we can see it, into military and strategic stockpiles, where we can't. If China decides to weaponize the silver market, they could simply slap an export ban on the metal tomorrow. They could say, we need all our silver for our solar panels, no more exports. If that happens, the COMEX breaks instantly. The United States relies on imports for over 60% of its silver consumption. We do not mine enough here. If the Chinese supply is cut off, and Mexico, the world's largest producer, continues to talk about nationalizing its lithium and potentially other minerals, North America is in a vulnerable position. This brings us to the paper versus physical divergence. This is the stage 3 I mentioned in the title. Right now, on the COMEX in New York, the open interest, the number of paper contracts promising to deliver silver, dwarfs the actual registered inventory. The leverage ratio is often cited between 20 to 1 and potentially as high as 400 to 1, depending on how you count the derivatives. Let's stick to the conservative numbers. Let's say there are 20 paper claims for every 1 real ounce of silver. In a calm market, this is fine. Most people trading futures contracts don't want the silver. They are speculators betting on the price. They settle in cash. But in a panic, in a run-on-the-bank scenario, that changes. If just 5% of the contract holders stand for delivery, the exchange defaults. There's not enough silver. When a delivery default happens, the exchange will declare force majeure. They will say, we cannot deliver silver, so we will pay you the cash equivalent at the closing price. Imagine silver closes at $60. You hold a contract for 5,000 ounces. You want the metal. The exchange says, sorry, here is $300,000 cash. You take that cash and go to a private dealer to buy actual bars. But the private dealer says, I don't care what the COMEX price is. My price is $120. Suddenly, the cash settlement you got is worth half as much in the real world. This is the moment the paper price becomes irrelevant. We saw this with nickel on the LME a few years ago. The market broke, trades were canceled, and chaos ensued. We are seeing the early tremors of this right now with the premiums. While spot is $58, try buying a monster box of Silver Eagles. You're likely paying $70 or $75 per ounce. The street price is already decoupling from the screen price. So let's talk about the price targets. Why $100 by summer? It comes down to technical momentum and the short squeeze. There are massive commercial short positions held by a few large banks. They have bet billions that the price of silver will go down or stay stable. As the price rises through $60, $65, $70, these banks get margin called. They have to put up more cash to cover their losing bets. Eventually, the pain becomes too great. They are forced to cover. This means they have to buy back their short positions. To buy them back, they have to buy long contracts. This buying pressure drives the price up even further, which forces other shorts to cover. It is a feedback loop. A doom loop for the banks and a boom loop for the holders. Once silver breaks the psychological barrier of $50 decisively, which we just did, the next major resistance is the all-time high near $50 from 1980 and 2011. Oh wait, we just broke that too. We are now in price discovery mode. There's no overhead resistance. There are no people waiting to sell at $60 because nobody has ever bought at $60 before. The sky is clear. Technical analysts using Fibonacci extensions project the next major levels at roughly $85 and then $120. If we hit $100, the market cap of silver would still be tiny compared to gold. Gold is a $14 trillion market. Silver, even at $100, is barely a fraction of that. The money flowing out of the overvalued stock market and the bond market needs a home. If just 1% of global pension funds decide to allocate to precious metals, the silver market is too small to handle the inflow. The price has to rise to accommodate the capital. So what is the bear case? What could go wrong? We have to be intellectually honest. The biggest risk to this thesis is a deflationary crash. If the stock market collapses tomorrow, I'm talking a 1929 style crash, everything sells off. People sell gold and silver to cover margin calls on their Tesla stock. In 2008, silver dropped 50% initially before skyrocketing. If we see a global depression, industrial demand for solar panels and electronics could drop. That would ease the physical shortage. However, in a deflationary crash, what is the response of the Federal Reserve and central banks? We know the answer. They print money, they print trillions, they stimulate, they send out checks, they bail out the system. So even if we get a crash, the response to the crash is inflationary. It is the same road leading to the same destination. One path is direct, the other takes a detour through a valley of volatility. Given that, how should you be positioned? If you believe the data, if you believe the Shanghai vaults are empty, the lease rates are real, and the industrial demand is inelastic, then you need to have exposure to physical metal. Physical silver, coins, bars, has no counterparty risk. If the power goes out, if the exchange closes, if the brokerage app crashes, you still own the metal. It is the ultimate insurance policy. For those with a higher risk tolerance, the mining stocks offer leverage. When silver goes up 10%, silver miners often go up 20 or 30%. Their margins expand explosively. But they also carry execution risk, political risk, and fuel cost risk. There is also the question of allocated storage. If you have a significant amount of capital, you don't want to keep a ton of silver in your basement. You use a private vaulting service, but ensure it is allocated and segregated. You want specific bars with serial numbers registered in your name, not a generic claim on a pool of metal. Avoid the unallocated accounts. Avoid the paper ETFs that cannot prove they have the metal. In a crisis, possession is 10/10 of the law. The Shanghai Signal is flashing red. The inventory drop of 86% is not a glitch. It is a warning. The transfer of wealth from the paper holders to the metal holders has begun. We are watching the end of a 40-year cycle of price suppression. The spring has been compressed for decades. Now, the hand holding it down is slipping. When it lets go, the recoil will be violent. It will be volatile. And for those who are prepared, it will be incredibly profitable. I will be tracking the Shanghai inventory numbers every single week. As we get closer to the summer delivery months, things are going to get crazy. I am expecting to see headlines about silver shortages hitting mainstream news like CNN and Bloomberg within the next 60 days. When your taxi driver starts talking about silver, that might be the time to worry. But right now, the herd is still asleep. You're awake. You have the data. I want to hear from you in the comments. Do you think the Shanghai depletion is real, or is it a data error? Are we seeing $100 this year, or will the banks smash the price back down to $40? Let me know your price target. If you found this deep dive helpful, hit the like button to help the algorithm share this warning with more people. Subscribe and turn on the bell so you don't miss the emergency update when the next inventory report leaks. Stay safe, keep stacking, and I will see you in the next video.